results. Revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
And Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off, sessions low, still down about 1% on the day for a little more than 4 pennies.
Well, today I would like to, last week we got together, we talked about sort of neutral options positions and how with income options trading, which is one of the things we do on the trading desk here at SMB, one of the things we teach, is the concept of, neutral spreads are something that are going to be successful when the market stays in a range. And that's great. And some people simply trade in ranges like me, every month, pretty much, unless I am convinced there's going to be some gigantic move, can't be avoided, and then maybe you sit out that month because the market's obviously not going to trade in a range that month. But typically, most options neutral traders are in every month because there's usually not a really compelling reason to say that the market's going to absolutely stay in a range. And even if there is, you could position yourself wider than that range, theoretically. So that's on neutral trades. Now, today we're going to talk about sort of the opposite, which is what happens if you have an absolute directional opinion on a stock, which is really because most of what you're doing these days is equity, learning about equity trading. Almost everything you do is about picking direction on a stock. So most equity traders are actually at least as interested in directional option strategies as they are in what I'd call non-directional strategies, also known as neutral strategies. So how would you play? But playing directionally with options income strategies is a different game than playing directional strategies with stocks. So let me talk about the differences a little bit. This is the chart of Google back in October 2012. What do you notice about that chart? What's the most noticeable thing in the recent stages of that chart? What's the most noticeable thing that happened? What was the dramatic thing that happened if you look at the far right side of the chart? There was a big sell-off, right? That was most likely options. Most likely earnings. And so you had this gigantic, look at that, it's like a 50-point drop in a day. That's a pretty serious drop even for Google. Okay? So that was pretty bearish moment for Google. It then the next day sold off a little bit more, and then it started to kind of channel for several days in that 680 area. Everybody see that pretty clearly? All right, now, my job is never to call direction. That's the job of the trader, to make up his or her mind where they think the stock's going from here. But if you do call direction, then there's a way to play it with options that's very interesting. And that's called a vertical spread. And today we're going to talk about a particular kind of vertical spread called a credit spread. So let's take a look at that chart a little bit. You guys have been studying this for several weeks now, so you maybe start to get a feel for how charts work and so forth. Where would you guess the first stop on the way down is on this stock? On the way down, and you can see the first stop really was 680, wasn't it? The market supported a bit at 680. Now, suppose that you were, at this point, bullish on Google, okay? Suppose you decided, you know what, that's a big drop. The market was had resistance at that 680 area there for a couple weeks, and then it blasted through that, came back down to it, and pretty much supported there, right? Okay. So you could say, well, maybe that's it. Maybe that's the end of the bearish move on Google, and it'll start grinding up from here. Wouldn't that be a logical, possible thing to think? Okay. I'm not saying that's logical or illogical. I'm saying you could think that, and there's logic behind it, right? Especially because it's supported for several days. Now, and again, my job's not technical analysis. I'm not very good at technical analysis. But my job is to craft options, strategies around a directional opinion that may come in. Now, so suppose you were bullish, but you wanted to determine the point where you're wrong. And on every trade, at one point, you're wrong. If you're wrong on the trade, you're wrong. If you're right, you're right. You don't know going in if you're right or wrong. So you always need to know where you may or may not be wrong. So what do you think would be the first point at which you'd say, if this stock blasted downward through that level, I may have a problem here. I may have been wrong about my bullish viewpoint. What do you think might be a point there on that chart? 670. Okay. And why would you say 670? Yeah, that area, I would argue, again, guys far more talented than I am in this area might differ and agree with you. But I'd be looking more at that 660 level, because you see how the market came up, kind of went past it a little bit, couldn't stay there, came back up to it again in April, couldn't stay there, finally got through it that was August, finally got through it in April. And didn't look back until early. Sorry, I'm sorry. I was right. It was April here. August was when it blasted through that level, which I guess was an all-time high, and then didn't really look back until October, when it started to sell off, and then had the bad earnings report, and then it really started to sell off. All right. So I would argue 660 might be a point where you're going to take a look at whether you're right or you're wrong. And there are no rights and wrongs in this whole discussion today. There's simply ways of handling your viewpoint, right? All right, so let's say we were bullish on this day, right? Then what I would do in this case is I would be looking at a credit spread. I probably wouldn't trade the November options chain, because it's pretty fast. 3 weeks that comes up, it won't give you enough time premium, which is something we discussed last time. So I'd probably be looking at this December, where you can get some decent time premium for selling this credit spread. And I've got a little tool here in my software which allows me to figure out where to find a 1 standard deviation move downwards. So statistics would tell you 1 standard deviation move is what, about 65%, something in that range, 64, 65% chance of that, of the market staying within a certain range. And so let's talk about, I've got to put the correct volatility in here, which would be about 21.7. To use the tool properly, I've got to enter some data in. I want to look at a 1 standard deviation move in the next 2 months, because that's the period over which this trade will last. And this is telling me that a 1 standard deviation move, I'm sorry, I'm at the wrong price point. That's what's throwing me off here. A 1 standard deviation move would be about down to 621.40. So can everyone see that? -1 means -1 standard deviation. So if you wanted to be super ultra safe, you'd go 2 standard deviations out at 569, but then you'd hardly get paid. You'd get paid something. You'd have a lot of risk and very little reward. So you try to balance your risk and reward situation. This gives you a decent reward and a decent amount of risk, basically. Okay? So let's go in and see what exactly I mean by how you can use options to play your bullishness on this trade. All right, so we go to 4 o'clock that day, and before the close, we put on this credit spread. And this credit spread is a 620, 615. What I did was I sold the 620 puts for December, and I got in $5.90, so I got in $59,000. I had to pay as my protection because I can't be naked options. Otherwise, if the market shot down and got down into 570, I'd be bankrupt. So I need to have protection. So I buy an equal amount of puts right below it at the 615 strike, and I pay $52,000 for those. So the net of what I received minus what I'm paying for my protection is $6,350. I had to pay $150 in commissions. So even if you don't understand every single thing going on here, isn't it intuitively sensible that, how much are you going to pay for a put for a stock that's trading at 677 to trade below 620? Because if you pay 590 even, the stock's got to get to 614.10 for you to even break even on the put. Okay? Because you're allowed to put, this gives you the right to put those shares to the one who sells you this strike at the 620 price. So the market's saying, you know what, I'm willing to take that risk for $5.90 times 100 times the number of contracts you're trying to buy. And the market's also telling me if you want to protect yourself, you got to pay me $5.25 for that. So the net of that is the 65 cents, but in options you multiply everything by 100. And we have 100 lot on, so it's 100 times 100, and it comes out to $6,350. So this is what the trade looks like graphically. As long as the market closes at 1 cent above 620 on the third Friday of December, then I get to keep that entire premium. Can anyone explain to me why I get to take home that $6,350? Who could explain that? On the third Friday of December, December 22nd, these options expire. These 620 puts give you the right to sell to me, Google, for 620. Now, if Google was trading at 680, would you want to sell your Google shares to me for 620? No. But suppose it was trading at 570. Would you exercise that put? Yes, because then you would basically have gotten back some of your loss, quite a bit of your loss, right? So if the market's trading at $620.01 on Friday, December 22nd, and it closes at 1 cent, will this 620 put have any value? None. How about the put below that? The one that I bought, would that have any value either? So I threw the money away on this one, and if I had only been naked, which is insane and nobody should ever do it, then you would take home $59,000. But because we're sensible people, we're not insane, we have to protect ourselves. So we bought this protection. But you can see why, if they all expire worthless, and I was paid initially $6,350 for selling the 620s and buying the 615s, then they all expired worthless. I got my $6,350. Do I owe it back to anybody? No. I pocket it. It's done. I sold something that was worthless for $6,350. So I win. Well, why do I get to do that? Because I took a lot of risk in that process. In fact, I took exactly $43,000 of risk in that process. So if I take risk, I deserve a reward. Right? So that's the game of vertical spread. So if you're bullish on Google at 677, is this a good idea? Yes, right? Because everyone likes $6,350, right? Now, can trades like this ever go bad? Of course, right? But statistically, because we put this one standard deviation away, and because of some other math which is complicated to explain, The probability of profit of this trade is 78%. I'm sorry. It's actually quite a bit larger than that, I think. Yeah, the probability of profit of this trade is 85%. So, are you willing to do something that has an 85% chance of winning, and you have a reward of $6,000 and a risk of 43? That's a little tougher question, right? The market wants to make you basically indifferent about that question. But a lot of it, and so what would turn the decision? Your bullishness. If you're bullish, you're going to do this because you think there's a very, very good chance that on that third Friday of December, Google's going to be at least $620.01. Now, I lied to you a little bit because the way you trade these, you don't wait for it to get to 620. If it gets to the market's allowed to drop to 620 before December 22nd. There's no law against that, right? If the market the next day after I put this on dropped to 620, I would be out about $16,000 to show you the risk in these. And there's a lot of risk in credit spreads, okay? So we don't let it get anywhere near there. Our maximum loss on this trade is 150% of our credit. What's the credit I receive for this? 6,300. Our maximum loss is 6,300. So, I'm sorry, maximum loss is 150% of that credit. So that number is $9,500 roughly. So at 9,500, I am out. Okay, so let's take a look at what happened. And I'm going to ask you guys, what you want to do at different points. There are different ways of handling a situation. One thing you're taught as an equity trader is if you're wrong, you hit out of the trade, you close the trade, right? With an options trade, you have alternatives to closing it. Sometimes the very smartest thing to do is close it. I would say at least half the time it's close it. But you do have alternatives, and we're going to look at some of those alternatives right now. So let's go ahead and move to 3:30 on what date? What's the date? Yeah, we're going to move to 12:30 on the 19th of November. Let's just kind of move a week at a time to see what was going on with Google. All right. Well, it did kind of hang in there at that 680 level, didn't it? So far, what would you guess is happening with the trade? Are we up or down a week later on November 1st? Think we're up money or down money on the trade? We're up money because the market moved in the direction we thought. And another thing, we're up $2,300 on the trade by then. Now, so what's happening is, as the market moves up, remember it was at 677 when we entered it. As the market moves up, and now it's at 687, is it giving more or less value to that 620 put that we sold? Less. Very good. Why?
Because the time passed by and it's less likely to go down.
That you gave two great answers. There's actually a third answer, which is more subtle but extremely important. And as you trade options, you'll get more and more and more aware of this third issue, which is what's called volatility. When the market rises, especially gradually, options lose their volatility, meaning they lose some of that premium that's in them to absorb the risk of that option. As the market sells off, especially hard and quickly, volatility rises, and sometimes rises very rapidly. For example, if the S&P, which is trading around 1940 something today, if that sold off to 1900 today, do you think volatility would go up or down? Options volatility. That would be a very, very big move on the S&P 500. And that the answer would be it would go up. It would go way up because the market would have fear. Now, so what happened was we were right in the beginning. Market's grinding up. By the way, I should have mentioned our target on this is 75% of our credit. Our maximum loss is 150% of our credit. Our target is 75%. And this is just one way to trade credit spreads. But in this particular technique, you target 75% of your credit. Your maximum loss is 150% of your credit. You're going to win these, if you do them right, a lot more often than you lose them, so you can afford to have a target that's less than your maximum loss, which is not true in most other forms of trading. Now, so let's move on to, let's say a week later, all right? Now, a week later, the market sold right back through where we were and now down below our level. So now, you know, this is all these trades are like a saga. And this is a long saga. It's a 2-month saga. This is not a day trade, okay? This is like a story. Now we're down money in this part of the story, right? So let's take a look at where we are in this analyzed graph. You see we've lost money. Time has passed, which has helped us. Time has passed. That's helped us. But now price is going against us. And we actually blasted through that 680 level where we thought we had support. We're probably starting to get a little nervous now. Maybe we shouldn't have been bullish. So remember, we had identified that 660 level as the next point where we have a decision. So let's take a look on November 18th. Let's move forward to, sorry, not November 18th, November 8th, excuse me. November 8th now, and we're going to look at, we're going to go to, let's say 12:30 on November 8th. Now, remember we had identified that 660 level. Well, where's Google trading now? Here's the price, market price, 658.50, right? So now we don't even have the comfort of that 660 level that we had identified as a likely area where the market's going to support. Well, it didn't support. So what do you think we ought to do? Are we down our maximum loss? No, we're down $3,300. That's that bottom line there, that, sorry, second to bottom gain loss line. We're only down $3,300. So we're only down $3,300, but we've broken a key support level. Would some people say, it's time to admit we're wrong on this trade. Let's not wait to lose $9,500. Let's just get out now while the getting is good. Wouldn't that be logical? Yes, that's certainly a very logical decision, and there are some traders who would make that decision. They will base their decision primarily on technical issues going on with the stock, as opposed to options issues. And that's very legitimate, because many times if a technical breakdown has occurred and you've got risk that would be brought into play with that technical breakdown, you may not want to wait around and see the ugly outcome, right? So you could close it, and that's a very viable and intelligent thing to do at this point. Are you going to win on every trade? If you're going to be a good trader, do you have to learn how to lose on trades? Yes. That's maybe in the top 5 most important lessons. When I first met Mike Bellafiore back 4 years ago, I asked him, what are the traits of a trader who's successful? And he put on his very short list that day people who know how to admit that they are wrong. We were wrong. So far, it looks like we were wrong about our bullishness on Google, okay? So very logical to say, let's just shut this down. But you could still be bullish. You still could think that this situation is going to correct. And you may have your reasons. You may have signals, indicators, commentary about the stock or whatever that led you to believe that this is a short-term phenomenon, and you're still ultimately bullish. But you want to get into a safer position in case your your stubborn bullishness is wrong, okay? So, and it's not, I shouldn't use the word stubborn, your persistent bullishness is wrong, okay? So let's go ahead and see what we can do here. What I would do at this point, hang on, let me just make sure I got the time right. 1:30, okay, so we can even go to 1. So we blasted through that level that was giving us a little bit of comfort, right? But what you can do at this point is you can go into your calculator here, and every broker, this is a particular piece of software I use, but every broker has similar software where you can do analysis of this type and determine standard deviations. So in this case, 660, the market's right at what? The market's right here at 660 on the button. And so at that point, actually, when I made this decision, it's actually 130, and the market was at 655 there. So just bear with me because that was the case. And when that was the case, one standard deviation now is no longer 620 because the market's moved down 17 points below where we were. So now that number's 605. Now a one standard deviation move from this point is 605. So might it make sense to say, hey, look, we're in the trade for 15 days now. The market moved down. What if we move down another one standard deviation from where the market is now? Might that put us into a bit of a safer position on the trade? If we move farther down and we're bullish, I mean, you don't do this unless you're still bullish. Would it make sense to move farther down, giving yourself some more safety, right? And the answer is yes. It would be logical if you were still bullish. So in this hypothetical example, I moved our credit spread down to the 605-600 strikes. I moved it down 15 points, and I bumped our lot size a little bit. Now, that's a little controversial. Why did I bump our lot size? When I closed, remember, we were down whatever it was, 3,800, 4,000 bucks, something like that, when I did this. We locked in that loss. When we closed that earlier 620, 615, by buying the 620 and selling the 615, that closes it. We locked in that $3,800 loss or $4,100, whatever that number is. Okay, we locked that loss in. We're rolling down now, but there's less time. You talked about time before. There's less time. So one standard deviation is worth less 15 days later than it was initially. So we've got to make back that loss somehow. So in a very judicious way, I didn't double my size, but I bumped it. This is all with the presumption that I am still bullish, okay? So bumping it judiciously, 25%, is not an insane thing to do. Now, the best we can now do is 4,138. Why? Because I took a $3,800 loss, and even though I reestablished the position and got another credit in, when you net out the credit I received from the loss that I locked in, the most I can now make on the trade, including that previous loss, is $4,100. So I can't quite make my target, which is a number closer to 4,700. I'm not going to be able to make my target on this trade, but I haven't given up the fight yet either. Again, no point in fighting if you've changed your directional opinion. So let's take a look at what happens now. Now, with this particular strategy, by the way, we only adjust once. If we adjust a second time, first of all, there hardly will be any premium left because it will be deeper into the expiration period. So the market's paying less and less and less for one standard deviation away. Second of all, if you're wrong, if the market moves against you and you've got to now adjust the second time, you're probably just wrong. So with this technique, it says, look, even if you're ultimately right, the market can move against you initially. That happens all the time. I'm sure you see that on equity trades all the time. You go long on something that's selling off, it sells off some more, and then it bounces. So it's not crazy to stay bullish, move down to give yourself some safety, and then see if you can make money on the trade. Now, a third thing we could have done, by the way, was said, I'm not going to roll down. The market's at 660. My position's at 620, 40 points below that. Okay, it's weak, but I'm going to hang in there, and let's see if it bounces. Because if you never roll and the market never gets to 620, then you would keep your entire 63.50, right? We made a very safe and conservative choice. Well, the most conservative thing would have been to close it. The second most conservative is to roll it. The least conservative is to do nothing. If you hit your max loss, you hit your max loss. Otherwise, you get to keep your 63.50. My feeling in this scenario was I'm willing to take a third less potential profit on the trade and be safer. Okay? So let's see how this plays out. Let's move to, why don't we do it a week at a time now? All right. Now let's take a look at what happened. Remember, we lost that 660 level, and now we are 4 o'clock on Wednesday, November 14th, and the market is below that level. Okay? The market's below that level. Let's take a look at this chart now. What happened here? We blasted through 660. Can you see that candle like 5 days ago? That was the big down move that got us through 660. Now the market's kind of hanging in there. All right? Several rally days, then a couple sell-off days, but nothing past that low that it hit that day. So we're right at, that low point that got us into this rolled position in the first place, right? Now, here's what's interesting. We were down. Does anybody remember how much we were down the day we rolled this? We were down $4,100, okay? Now the market's exactly pretty much at that same point, only 3 points lower, and we're down only $2,900. How can that be when the market's actually dropped a little further against us? How can it be that we're not down as much a week later? The answer is time. As every day goes by, all other things being equal, and all other things are never equal, but all other things being equal, options lose value. Time is the enemy of an option. So since we are short options, we're net short them, we have gained from the fact that the market didn't move much. What would happen if the market just stopped moving until the end of the expiration period? We would win, right? Because we're down at 605. The 605 and the 600 would expire worthless, and our $4,100 would be ours. Okay? So I say in options, time heals all wounds. Time is working with us now. And so you can see what can happen on these trades now. Simply the passage of time. We've been wrong. Have we been right so far? No, we've been wrong the whole time. The market continued to sell off, but we're only down $2,500. We had to roll down. We locked in a $3,800 loss. We're still down now. We're actually down less than we were when we locked in that loss. And so therefore, the current spread is actually up money if you think about it. All right. So let's go another week. So there's absolutely no reason to be optimistic at this point. But even without any reason for optimism, the situation is not very bad, right? Well, look what happened a week later. I'm just randomly, moving through here 1 week at a time. Week later, market rallied back up past that 660 level and now is hanging out in the 670 level. So we're now actually up money on the trade. So even though we locked in a $3,800 loss, we're now up money. You see, this is the zero line on the profit curve. We're now up money on this trade. So, and time's passed. Now there's only 32 days left for the market to nail us and sell off, and start creating serious trouble for these 605s. Let's take a look at the price chart now. Okay, so you see here, you see here that the market has, rallied. It actually almost got up to 680, I guess this day, came back down, but now it's rallying a little bit. This still is not a very bullish looking situation to me, but it's starting to stabilize in this area. And all we need really is for it to just not go down that much more, and we're going to win. Okay? Let's take a look at, now this is a week later. Market's just kind of hanging in there. Let's take a look at another week. Let's go into December. December 3rd. And December 3rd now, the market's really rallied. And it's coming back from that earnings sell-off. Now, look where we are. We're up $3,500. And that is because time has passed. Everything's working for us now. Time is always working for us. Every day we're making a little money on these spreads, all other things being equal. We wanted the market to go up. We wanted to go farther and farther away from our short puts. It's done that. And what was that third item I mentioned, which is a little bit mysterious? Volatility. Volatility, when the market grinds up, usually volatility are going to come out of these options, and that's what's happened in this case too. So I had everything working for us. Doesn't always work out this way, but it worked out in this case. So let's move to a week later. Now market's at 682, above where we were when we entered this saga. Above it. Now let's see, it's interesting. We're still in that $3,300 range, and now we have 15 days to go. So let's go into the final week, the Monday of that final week. Let's see where the market is here. Okay, now the market's really rallied. So here, here we have some interesting decisions to make. Market's really rallied. Now we're up 33.25, it looks like, right? Actually, I'm not sure why we're not up more. 33.25. There's something wrong with these valuations. There's something a little goofy about this. I'm not sure what that is. Yeah, okay. So now we've got a week to go. The most we can make on this trade is 41.38. Now, at this point, most traders would look at this situation and say, all right, now we've got, you have to look at what's going on with these options. The 605, look, we're at 718. What are the chances now Google in the next 4 days are going to drop to 605? Not too great, not too great. Could happen, theoretically, but you would never do a trade like this, by the way, if earnings was coming up, because that's the one scenario where you could have a 100-point drop. I don't think it happens much, but Google's made some gigantic moves on earnings, okay? So you would never do a trade like this around earnings because you could get trapped in the middle of an earnings sell-off and then you really, really regret it. So what you need to look at in this case is this. The short put that we sold, let's look at the price we got for that. I've got a way of capturing that here. The original price I got for this short put was $4.85. The long put that I bought to protect it was $4.20. Today, the short put is worth 15 cents. The long put's worth 12 cents. So what was the credit per contract I received when I first entered into this rolled portion of the trade? 65 cents. Excellent. Now what's that credit worth? 3 cents. Okay, now, I still have, theoretically, $54,000 of risk here. I have $54,000 of risk. If something horrible happened, they dropped a bomb, God forbid, on whatever, New York City or whatever, I could theoretically, if the market somehow dropped Google 100 points in the next 4 days, I could lose $54,000 on this trade. Is that likely? No. There are some people, and I'm among them, who will, even though it's so unlikely, I'll say to myself, Seth, 3 cents times 12,500 is what? That's $375. For that additional $375, is it worth it to be exposed to $54,000 of risk for $375? Some people would say yes, because the chance of that happening is so infinitesimal. Just deal with the risk and get your $375. And that's a very logical thing. And I would say most traders I know would probably say, just leave it. It's going to expire worthless. Don't pay any money to close that out. I am conservative, so I might do some different things. I might buy back half of them, something like that. Spend $180 just so I could sleep a little better at night. Okay? But that's a decision point. There are points and options where your risk-reward trade-off is terrible. This is one of them. The reward is $375. The risk is $54,000. But then you have to weigh probability into the equation. And when you bring probability in, it makes sense in many cases. Just leave it alone. Most people would just, what they call, expire this position, meaning just like the market, close it out, everything expires worthless, nobody pays anybody any money, you just walk away with your premium. So what do you think happened? So we're going to go to the last trading moment of Friday, December 21st, and you will see that they're going to expire worthless because the market's up at 715.60 at 4 p.m. So they expire worthless. We keep our entire premium. So the moral of the story is there's a lot of ways to trade what are called credit spreads. That's what we discussed today. The cool part about them is you can be wrong and still make money on them, because even if we left the original trade alone, the market never got to that 620 level that was our original point where those options would have been exercised, right? Where we would have lost money. It never even got to 620. So we actually, if we weren't worried about hitting our maximum loss, might have said, you know what? We are still bullish on Google. We're not moving. We're going to tough this out. And then you would have made 63.50. So even if you are wrong, remember we were at 677 when we started. The market could have gone to 630. We were wrong, and we win $6,300. But in this case, we used a sensible approach, which is to take some of the risk out of the trade if it's going against you, but it's not completely clear that you're dead on the trade. That is a kind of the middle way that you can use, and most options traders would trade that way because it's so dangerous not to. So that's a little bit of a lesson in credit spreads, and this is another way that you can play the market. You can play the range, because if you think about it, what I was really doing was playing the range 620 to infinity. So I really was playing a range on this trade, but the great part is you can be wrong as long as you're not dead wrong real fast. Credit spreads have a good chance of winning. In fact, statistically, it's 85%. So that's really the lecture for today. All right, have a great day, and maybe we'll see you next week and get into something else in the options area. Okay, thank you.